If you're paying any amount of taxes this year to the US government, pay attention to this video today because you may be wasting a lot of money. So right now, we're in the early year of 2024, which means that you're filing your taxes for the year of 2023. So how do taxes work? Well, your taxable income is actually divided up into chunks that are correlated with a specific tax rate, and you pay the associated rate for each of those chunks. You can see the chart of brackets for those that are married and filing jointly here, and below it, you can see the bracket chart for those that are filing as single individuals. Let's start on the chart for the single individuals. Let's say you're single and make about $65,000 a year of taxable income. Then you'd be in this bracket, and you'd simply be taxed $5,147, and then additionally take $65,000 minus $44,725 and multiply that difference by 22%. And then add that to $5,147. That's the total tax you owe for 2023. Now let's say that you're married, filing jointly with your spouse, and make the same amount of taxable income, which is $65,000. Then you're in this tax bracket. So you'd be taxed $2,200 plus the $65,000 minus $22,000 and multiply that difference by 12%, giving you this amount. So as you can see, you clearly save about $2,300 by simply being married and filing jointly. Now on average, a person works about a third of their year just to pay the IRS.
I'm done. Cut the show. I'm done. Take me off.
And there's perfectly legal ways to get around this by making your taxable income look as low as possible. So let's focus on three main ways of reducing the amount of taxes that you owe. These three ways are credits, deductions, and exemptions. Exemptions are incomes that qualify as being non-taxable. These include some scholarships and portions of retirement. Exemptions indirectly reduce your taxes owed by lowering your taxable income, and this amount of money changes based on what bracket you're in. For example, if you're married and filing jointly and you made $95,000 last year, then that'll mean that you're in the 22% tax bracket. So let's say that a piece of that $95,000 that you made was a scholarship. More specifically, let's say the scholarship was about $1,000. And let's say that that scholarship qualifies as being tax exempt. So that lowers your taxable income to $94,000. So how much money did you save? Well, because you're in the 22% tax bracket and you reduced your income by $1,000, then you take 22% of that $1,000. And that's how much you save by having that scholarship be tax exempt. Now, the higher the tax bracket, the more savings there is. So for example, if you're in the 37% tax bracket, you actually save $370. Now, deductions are very similar to exemptions, except that instead of being income, they are expenses. So deductions are qualifying expenses that can be deducted from your taxable income. So these can include some medical expenses, charities, mortgage interest, and state and local taxes. So let's say that you paid $12,000 last year in mortgage interest. And let's say that you're in the 22% tax bracket. Well, then you save $2,640 in taxes. Now, when you're filing your taxes, you can choose to itemize these deductions and exemptions, but that tends to benefit the more wealthy people. To simplify things, all filers are eligible to claim a standard deduction instead, which tends to benefit those with lower incomes. So this standard deduction changes from year to year. So for 2023, it's $27,700 for married couples and $13,850 for single filers. Now, whether you choose the standard deductions or you choose to itemize your deductions, you can still apply further deductions called above-the-line deductions. This includes interest paid on student loans or contributions made to an individual retirement account. The third way that you can reduce how much taxes you owe is through tax credits. A tax credit, unlike exemptions and deductions, actually directly reduces the amount of taxes owed. So for example, in the year 2023, if you made under $400,000 and you claim one child as a dependent, then you qualify for a maximum $2,000 child tax credit, and that is directly deducted from how much taxes you owe. Other things that qualify for tax credits are adoptions, having low income, you or your child being enrolled in college, buying an electric vehicle, having solar panels on your home, and investing in retirement. So for example, just for the clean vehicle tax credit alone, you can actually max out at $7,500 of tax credit in a year. Furthermore, if you make eco-friendly improvements to your home, like solar panels, that can actually qualify for even thousands more. So you definitely need to look into these if they apply to you. Now, if you're eligible for child tax credit, but the amount of taxes that you owe is actually less than the credit that you'll be getting back, then you don't get the full amount of that refund. However, that brings me to a very important bill that's being passed through Congress right now, and that's a retroactive bill for the year 2023, meaning that it's applicable for all the taxes that you're filing right now. Now, this bill lifts that rule and makes it to where lower income families that owe less taxes than their tax credit will actually still be able to get that money back. So I'm going to list about 6 different categories of people that are filing taxes, and if you fit in one of these 6 categories, do not file your taxes until January 29th, until this bill is ironed out and implemented. Otherwise, if you file before, it's just going to sit on the doorstep of the IRS. They're not going to get to your taxes until January 29th anyways. So you might as well wait until this bill is carried out. If you file too early and you have to make a correction, then you have to file for an appeal, and that costs up to 3 months of time plus a lot of money. So you don't want to do that. So if you're in one of these 6 categories, do not file your taxes until January 29th. Now, if this isn't enough for you and you want all the money,
I don't want 8 waffles, I want 12. I want 12 of them.
well, then you're in luck because there's a lot of ways to keep as much money as you can. For the sake of time, we're only going to be covering 2 of these. First, I recommend contributing to an HSA account. So what is an HSA account, or a health savings account? A health savings account is designed to cover out-of-pocket medical expenses, and what adds to the appeal of this account is that it's actually tax-free. Furthermore, this account allows for investments. It's important to note, however, that there's a max contribution amount that you can make per year. For single people, that amount is $4,150 per year, and for family plans, that goes all the way up to $8,300 per year. Now, there are a couple catches. To contribute to this account, you have to have a high deductible insurance plan, which in 2024 translates to $1,600 per individual coverage. Or for a family plan, that's $3,200. Additionally, your out-of-pocket maximum should not exceed $8,050 for individual coverage or $16,100 for a family plan. So if you utilize one of these HSA accounts, this means that you're essentially investing tax-free money. And when you utilize it for paying out-of-pocket medical expenses, you don't have to worry about paying taxes on it. So let's break down the savings in a practical scenario. Let's say that you're in the 22% tax bracket and you fully max out your HSA account. This means that you stand to save $913 per year for a single plan. So if you meet the necessary criteria, this approach is one of the most straightforward ways to save money on your taxes. The second way that you can save a lot of money in your taxes per year is taking advantage of the long-term capital gains tax break. So when you make an investment and sell it within 12 months, that profit is actually subject to your ordinary tax bracket, meaning that you can go all the way up to 37% tax on that profit. However, if you decide to hold on to it for longer than a year and then sell it, the taxation shifts to a whole new chart, which is the long-term capital gains tax rate, peaking at 20% with a standard rate of 15%. Notably, individuals who make under $94,000 when filing jointly as a married couple are exempt from owing any taxes, rendering their gains literally and entirely tax-free. Now, the last thing I want to include on this video is a tax calculator, and it's a way to calculate your baseline of taxes that you owe from the previous year. So to get to this, you type in tax calculator in the Google search box, click here, and then fill out the boxes as follows. So that's it for this video. I hope that this helps you this year in filing your taxes and that you save some really big money. Please subscribe to my channel if you found any value in this. Next week, I'm going to go into more detail on taxes and how to save if you own a small business or if you own real estate. So it's a little bit more in depth. So if you're into that or if you own any of those, please stick around and I'll see you next week. Thanks so much.